Have you been wondering how to calculate the intrinsic value of a stock? Well, then you're at the right place. Let's get started. Hey, what's going on, you guys? Welcome to my channel, Investing Untangled. Here I post videos about stock market research, detailed business and stock analysis. And if this is something that interests you, then hit the subscribe button and the notification bell and follow my content here. So in this video, I'll summarize rule number 1 investing book for you. It is written by Phil Town, who's a very famous author. He has written multiple books in this field, and he also hosts a very popular podcast called Invested. Previously, I also summarized the book called The Dhando Investor, and I'll be referencing that along the way in this video. So Phil Town in this book basically explains the methods and techniques that he uses to identify companies that he's interested in. He talks about the ratios and the financial metrics that he looks at before making investing decisions. And what I really like about this book is that he defines competitive advantage in very simple terms. Competitive advantage of a company is also called an economic moat, and he identifies specific indicators which he calls the moat indicators, and they show to him if a company has a moat or not, and he very distinctly defines them. I have included all those definitions and all those examples in this video for you. And finally, in his book, he also shows how to calculate the intrinsic value of a company. He uses current EPS and future growth rate. I'll use an example of Facebook in this video to show you how it works. So let's get started with key takeaways from this book first before we jump onto the intrinsic value calculation. And the key takeaways are: number 1, diversification ruins your returns, and focus on a few simple businesses. If you can value a business, if you can analyze a business, just focus on a few simple businesses. Don't over diversify your portfolio. That will reduce your returns. Phil Town also heavily talks about moat indicators, and he actually defines these moat indicators very nicely. So he categorizes them in the following categories: so brand moat, secret moat, toll bridge mode, switching mode, and low price mode. So I have done a video previously where I explain all these modes with an example. I've linked that in the description below. So briefly, brand mode is a company that has a very strong brand going for it. For example, Coca-Cola. Secret mode is some kind of proprietary protection like patents, copyrights, etc. A lot of pharmaceutical companies, also semiconductor companies like Intel, have the secret mode going for them. Pharma companies like Pfizer, Johnson & Johnson can actually file patents for their drugs that protects their products from generic medicines. Toll bridge mode means a company which has an exclusive control of the market. For example, you can think about Boeing. Boeing is in a very sophisticated industry that manufactures aircrafts, and it is just one of the biggest players in the world. It's not easy to compete with a company like Boeing. There's just one other company, Airbus, in the world, and that's pretty much all. So they have an exclusive control of the market in that sense. The other one is the switching mode. If it becomes very hard to switch from one product to another one, for example, Microsoft Word and Microsoft PowerPoint or Microsoft Office in general is very popular, and a lot of people have a hard time finding an equivalent program which offers all these features. Another example is switching from Apple products which are not compatible with a lot of Android products. It becomes very difficult if you're just used to Apple products. That gives this company a strong switching mode. And then finally, low price mode is when a company prices its product so low that gives them a particular competitive advantage, and it's not easy to compete with a company like that. For example, Walmart or Costco have their products so low that some other competitor will have to drop its profit margins drastically to compete with a company like that. And Phil Town actually talks about actual numbers that you have to look at. So he talks about these big 5 numbers that he calls in his book. They are ROIC, which is return on invested capital, BVPS is book value per share, EPS is earnings per share, sales, and FCF is free cash flow. And Phil Town suggests that you should always buy companies that have all these big 5 numbers growing significantly. And he suggests a growth of 10% in these big 5 numbers over the last 10, 5, and 3 years. And if you do see a 10% or more growth in all these 5 numbers over the last 5-10 years, that actually indicates a moat, that the company is able to steer away from competition and keep its sales and earnings growing. Phil Town also suggests that we should limit the speculative stocks in our portfolio to less than 10%. And with speculative stocks, he means newer businesses that aren't established yet, that are not making any money yet, that are not having any earnings yet, and you should not have more than 10% of your portfolio exposed to these companies. He also suggests that you should buy companies that can pay off their debt within 2 to 3 years based on their free cash flows, meaning these companies should have very little to no debt. And finally, he teaches in his book how we can calculate the sticker price, and the formula that he follows, he calls the intrinsic value of a company the sticker price. He uses EPS, future growth rate, and future PE for this calculation. And in this sense, this method is different from what Monish Pabrai describes in his book. Monish uses free cash flows and discounts them back, while Phil uses EPS instead of free cash flow. I generally use multiple different models of valuation, so I use this one, also DCF, also some others to figure out the intrinsic value. So where do you get these numbers from? So he says future growth rate percentage, you can use the past 10-year equity growth rate as the future growth rate percentage. And I have added a little modification to this step here. I also check current analysts' estimates, and then I become conservative on this. Whatever is lower, I take that one as my future growth rate. For the future PE, Phil suggests that you should double the future growth rate percentage that we got here, or you can use the 5-year average PE that the company has had in the last 5 years, the average PE. And again, you have to be conservative, so whichever is lower of the two. So I'll show you how this valuation method actually works, and I'll use an example of Facebook to calculate the sticker price using this model. So here I am on the Morningstar page of Facebook, and you need EPS for this calculation. So the current EPS of Facebook is $10. To figure out the growth rate, Phil suggests to use equity growth rate, which on a per share basis is book value. So we can take these values right here. So in 2012, Facebook's book value per share was $4.96, and right now it is $45. So I'll calculate the growth rate at which Facebook has grown its equity, and I'm using Rule 1 investing calculators. So this is Phil Town's own website, and he offers this for free. There are a bunch of different calculators that you can use, and this one is the equity growth rate calculator. So if you just Google it, Rule 1 investing calculator, equity growth rate, you'll get it. So the initial value was $4.96, current equity value is $45.05, and this growth happened over a time of 8 years. So the growth rate is 32%. I added this modification where I want to check also what analysts think. So if you go to the Yahoo page of Facebook and you go to analysis and go down to next 5 years, so here you see analysts think that the company is going to grow by 21.5%. And then I use the growth rate that is lower. 21% is lower than what we got here, 32%, so we'll use 21%. The next thing you need is the future PE. Phil Town suggests using 5-year average PE, which you can get from Morningstar if you go to valuation here. So this is 38, and he also says that you can actually double the growth rate, which in this case we settle on the growth rate of 21.5. The double of that will be 43, and then he says you should use the lower number. So in this case, 38.7 is clearly lower than 43, so we'll go with 38. And then if you go to his margin of safety calculator again on his Rule 1 website and plug these numbers in, so the current EPS is 10.09, future growth rate we settled with 21.5, and future PE we are with 38.7. Phil Town suggests using a minimum acceptable rate of return of 15%, meaning you'll be getting 15% on this investment annually. And on this percentage, you can see the sticker price, which is the intrinsic value of the company, is $677. And then he applies a margin of safety where he divides this by 2, meaning 50% margin of safety. And that's how he comes up with the buy price. So this is the buy price with margin of safety. And you can see the buy price using this method for Facebook is $338, and Facebook right now trades at $258, meaning Facebook is undervalued significantly using this valuation model. I did actually a whole video on Facebook and why I think it's a good investment at these prices. I'm leaving the link of that also in the description below for you to check out. I really enjoyed reading this book a lot, and it has helped me a lot. And especially it's catered towards beginner investors. So if you are beginning your investment journey, please consider reading it. If this video was informative and you got value out of it, please consider leaving a like and subscribe to my channel, Investing Untangled. That'll help my channel a lot. In the future, I'll be doing more videos about stock market research, business, and detailed stock analysis. So stay tuned to my channel, and I'll see you in my next video.